You've been approved for a mortgage. Sounds exciting, but approvals often exceed what you can truly afford, leaving many homeowners financially strained. If you're a first-time homebuyer in your 20s, there are 5 critical financial blind spots that could derail your home ownership journey, and most mortgage advisors won't point them out. I recently worked with a couple who almost fell into this trap. Today, I'm showing you the blueprint that prevented my client from making costly mistakes that could jeopardize their financial future. What are these 5 hidden pitfalls and how you can avoid them? Why is your mortgage just the tip of the iceberg? These are the hidden costs. Ever notice how lenders only talk about your monthly mortgage payment? There's a reason they don't mention the other 40% of home ownership costs.
What?
When you're scrolling through those real estate apps, the estimated mortgage payments look doable, right? But here's what they are not telling you. The mortgage payment is just the beginning of your financial commitment. Most first-time homebuyers in their 20s make the same critical mistake. They get pre-approved for a loan, see that monthly mortgage payment, and think, great, I can afford this. They compare it to their rent payment and assume they're making a lateral financial move. But that's far from reality. Imagine your monthly housing bill suddenly doubling, all because of the cost you didn't plan for. Like an iceberg, what's visible above water is just your mortgage payment, while massive structures of expense lurks beneath. Your mortgage payment typically represents about 60% of your total monthly housing expense, with the remaining 40% hiding in plain sight. When budgeting for home ownership, financial experts recommend following the 28-36 rule. This means your total housing costs shouldn't exceed 28% of your gross monthly income, while your total debt payments should stay below 36%, and this buffer exists for good reason. Those hidden expenses add up quickly. Let's examine a realistic example. Let's just say you purchase a $300,000 home with 10% down and a 30-year fixed-rate mortgage at 6.5%. Your principal and interest payment comes in about $1,706 a month. Sounds manageable, right?
I think so.
But that's just the foundation of your expense pyramid. Property taxes add another $300 monthly at a conservative 1.2 annual rate. Homeowners insurance costs at least $100 a month with less than 20% down. Private mortgage insurance adds roughly $125 a month. So living in a neighborhood with an HOA, that's another $200 to $600 depending on the amenities and the location. Then comes utilities. Unlike rentals where some utilities might be included, homeowners actually pay for everything. Water, sewer, garbage, electricity, gas, internet, easily another $300 to $500 a month. The final piece, maintenance and repairs. Experts recommend setting aside 1 to 3% of your home's value annually. For that $300,000 home, that's $250 to $750 monthly. One failed water heater, roof repair, or HVAC issue can easily exceed this budget. Adding it all up, $1,706 for your mortgage, plus $300 for taxes, $100 for homeowners insurance, $125 for private mortgage insurance or PMI, plus $250 average HOA homeowners association dues, plus $400 in utilities and $300 in maintenance. That is $3,181 per month. That's nearly double what many online calculators show you as your monthly mortgage payment.
Wow.
This is why Dave Ramsey suggests keeping your housing payment under 25% of your take-home pay, not gross income. This conservative approach provides a safe buffer for young buyers, allowing room for unexpected expenses and future financial goals. Here's a practical formula for your true housing budget. Take your monthly gross income, multiply it by 0.28, then subtract estimated property taxes, insurance, homeowner association fees, and maintenance budget. What remains is what you can comfortably spend on principal and interest. Despite these sobering figures, buying your first home remains the #1 wealth building strategy in your 20s. When you purchase within your true budget, you're able to continue saving, investing, and enjoying life while your property appreciates and your equity grows instead of becoming house poor. The next thing to consider is going to be the debt-to-income ratio dilemma. The number matters more than your credit score. When we talk about what stops you from getting a mortgage, most people immediately think about their credit score. But here's something that might surprise you. Banks are regularly approving people with stellar credit scores for loans they struggle to repay. Why? Because they're looking at another number that reveals far more about your financial health than your credit score ever could. In addition to hidden costs, another silent factor that can derail your home ownership dreams, your debt-to-income ratio. This debt-to-income ratio is like the foundation of your financial house. Without a solid one, the entire structure becomes unstable. This single number determines your purchasing power more than any other factor, yet most first-time homebuyers have never calculated it. Debt-to-income ratio is simply the percentage of your monthly income that goes towards paying debts. Lenders then calculate this by adding all of your monthly debt payments, student loans, car payments, credit cards, and your potential mortgage payment. Then we divide it by the gross monthly income, and here's where things get concerning. Many mortgage lenders will approve you with a debt-to-income ratio as high as 43, and some even stretch it to 50 and even 76. Think about that. Half of your pre-tax income goes just towards the debt payment. After taxes, you might have just 30% of your paycheck for everything else: groceries, utilities, savings, and unexpected expenses. These high DTI loans come with a hidden penalty. Lenders charge higher interest rates to riskier candidates with higher debt-to-income ratios. You're not only stretching out your budget paper thin, but paying more for this privilege. Student loans particularly impact young buyers. If you and your college roommates both earn $70,000 annually, but your friend has $500 in monthly student loan payments, $350 for a car loan, and $200 in credit card payments, your purchasing power could be $100,000 higher despite identical income. That's the difference between your dream starter home or settling for less. Consider this example. Two buyers both earn about $6,000 monthly with perfect credit scores. Buyer A has zero debt and qualifies for a $300,000 home with a comfortable 30% debt-to-income ratio, whereas buyer B has $1,500 in monthly debt payments before even considering a mortgage. Their debt-to-income ratio is already at 25% without housing costs. Their maximum qualifying home drops to around $200,000, a dramatic reduction despite identical incomes and credit. This is why proper pre-qualification is essential before you start scrolling through Zillow or touring open houses. Nothing is more heartbreaking than falling in love with a home only to discover you can't afford it.
My heart hurts!
Pre-qualification gives you a realistic budget based on your unique financial situation, including your debt-to-income ratio. For first-time home buyers, many programs offer amazing benefits like down payment as low as 3%, but these programs often have stricter debt-to-income ratio requirements, typically below 43%. They're designed to help you succeed as a homeowner, not set you up for financial struggle. What is the ideal debt-to-income ratio for a young home buyer? Experts consistently recommend keeping it below 36% to provide breathing room for unexpected expenses. The correlation between a high debt-to-income ratio and foreclosure rate is significant. Borrowers with 43% are statistically much more likely to face financial difficulties. Remember, this isn't just about buying a home, it's about building a future. Financial experts have found the true secret to success for young homeowners isn't stretching to buy the biggest home possible, but maintaining financial flexibility that allows you to handle unexpected expenses without stress. This breathing room prevents missed mortgage payments that often result from carrying too much debt. Transform your dreams into a reality with a plan that is as unique as you are. Calculate your housing budget using the 28-36% rule, get properly pre-qualified, then click the link below to connect with me and my team for your personalized roadmap. Your first home purchase isn't the finish line. It should be the foundation that supports all of your other financial goals, becoming the springboard that makes everything else possible. I'm 𝐸𝐻𝐲 Mortgage Guy. Hit the notification bell, subscribe to my channel, and comment down below if you want me to cover any topics in future videos. I'm 𝐸𝐻𝐲, and I'm out.